answer. Oop, let's see. I'm happy to answer any questions, as we go. Or if I'm speaking too fast or too slow. I'm from Georgia, so I'm from the southern part of the US, and I speak slowly anyway, because that's how we do here. But please let me know if I need to speak up or anything. So let's get into it. This is hopefully going to be an engaging few topics, and I've listed some of them out. I have a lot of slides, one of the largest slide decks I've put together in a long time. So I suspect that we're not going to make it through all of the slides, and some we'll just go through very briefly. But we put the slides together so that you can use the slides after this class, and the content will be self-explanatory. And there'll be enough detail for you to understand, what we're trying to convey, regardless of whether we get to the slide tonight or not. So that's my hope anyway. And here's the agenda. The numbers 2, 3, and 4 were specifically requested, and that's perfect because it leads us right into what you need to do a benchmarking analysis, which is what our TP Catalyst tool is going to do. So so that's perfect. I think the first couple slides were just me being excited about the transfer pricing regulations in Brazil. So we can probably skip over the first couple of slides, although one of the things that is interesting is that that some companies, because it's such a drastic change, it's going to be very interesting to see how companies adapt. They're going to have to adapt their policies. They might also have to adapt, the actual payments that are being made between the group members. And the other thing that's going to be very interesting is to see what the tax authority thinks of these new policies, new processes, and new ways to benchmark a transaction. I guess what's most going to be interesting is to see what they accept and what they don't, because a lot of what we rely on in the US is case law, where there's been a disagreement with the IRS, our tax authority, and then it's gone to court. And so you see what's been decided in court and you can rely on that. But because these regulations are very new, there's no case law to refer back to. So I think that's going to be very interesting. We're starting from the very beginning. So let's skip past these two slides and we'll talk about comparability factors. And so all of the content in these slides, it came from a few different places. It either came from the regulations that were published by your tax authority, or it came from what I learned, how I was taught to approach a transfer pricing analysis, or it comes from what I've heard from tax authorities. We work with about 80 different tax authorities globally, so we talk to them very, very often. And so they let us know what they're thinking. And so some of the content here comes from that, and it also comes from other practitioners where, the transfer pricing world, it's very small. And sometimes it seems like we all know each other. So some of this is coming from other practitioners that I've known in the industry. This slide actually comes from the publication from your tax authority. And this is the list of the things that need to be considered when you're trying to determine comparability. And I've highlighted the second bullet because it's the bullet that you will hear most often about from a transfer pricing person. It's the functions, the risks, and the assets. That's all that is. I dream about functions, risks, and assets. you talk about it all day long. Even clients begin to talk about functions, risks, and assets. And that's what you hear, in most any conversation or at any conference or anytime you deal with the tax authority, it's going to come up. So I've highlighted that, and we'll go into that a little bit more. But just to touch on the other bullet points on this slide. The third bullet point about the characteristics of the goods or services and the business strategies, those 2 bullet points, they're important. That information is covered in a documentation report. It's usually going to be in the chapter where you're describing the business, the company description chapter. And so those are important, but the functions, risks, and assets, they get their own chapter. So they're not just a piece of a chapter, they make up an entire chapter of a documentation report. And that is going to be the case in almost every country that has transfer pricing regulations. It all falls back to that analysis. And that's what is the very beginning of your benchmarking exercise. On here, the other bullet point that I would just mention briefly, it's the first one, the contractual terms. So those are the terms that you find in your intercompany agreement or your intercompany contract. And I have a little bit of a love-hate relationship with intercompany agreements because maybe 20 plus years ago, intercompany agreements were very different than they are today. A lot of clients or a lot of taxpayers, they didn't have intercompany agreements. They weren't that important, but if you did have an intercompany agreement, a tax authority would look at it and say, okay, here are the terms. Here's how the agreement describes the transaction. Here's how the 2 parties interact. Who's doing what for whom and how it's being paid for. And they might not even look at what was actually happening in real life, how the business was actually operating. So it was very much a form over function. But now it's very different. The last few audits that I was involved in, and even now when I'm speaking to tax authorities, they bring it up. Intercompany agreements are very important, and they're one of the things that will be requested when a taxpayer is under audit. The same time that a documentation report is requested, if it hasn't already been turned in, will be the time that the intercompany agreements will be requested. And now they can hurt you more than they can help you. And that's because if the facts and circumstances described in the intercompany agreement, if they don't match what's going on in reality, what's actually happening, it can be disregarded. Unless the tax authority has decided that those facts and circumstances can help them, they like that story better than the real story, or if no actual story is being told. Like in the US, we're not required to turn in documentation reports. You're supposed to have them, but you don't have to turn them in. So if a lot of taxpayers don't actually have documentation reports. So if you don't have a report listing out and describing the intercompany transaction, a tax authority can take your intercompany agreement and assert that all of those facts, all those circumstances are actually what's happening. So intercompany agreements are a little bit tricky. It's important to make sure when you're thinking about comparability and you're thinking about how your related parties are interacting, you need to make sure that your intercompany agreement, that contract, matches what your documentation report is describing, and that also matches what's actually happening. So with that in mind, why don't we get into the first, I'm jumping the gun a little bit because I'm excited to talk about the next part, but so I added this slide just because these were listed in the document from the Brazilian Tax Authority. And I listed these because almost every one of these bullet points can be adjusted for. So even if your comparable company, even if there's a difference between any of these contractual terms and how it's interacting with its suppliers or its customers, even if any of these terms are different from how the related party is interacting, with its affiliate, all of these things can be adjusted for. So after you find a comparable company, if it's a good one, just remember that even if there are some differences, perhaps they can be adjusted for. And we'll talk about this towards the end of the presentation. Okay, so as I was thinking about comparability, the first part of determining comparability, it's your discussions with the client and it's your information gathering. So I pulled some information requests that I had actually used with my clients, and also some information requests that I had gotten from a couple of different tax authorities. One was from the IRS, one was from the German tax authority, and one was actually from the Italian tax authority when I had clients that were under audit. And I was comparing mine with theirs. And these are the first 4 things that were listed on my information request anytime I started a new project with a client. Even if it was a client that I had been doing their transfer pricing for years, I would still send them this every year at the beginning of our conversations to update their documentation. And even some clients would say, you send me this every year. Why do you send me this? It's still important because over time, the business changes, facts change, new documents are drafted, and it's important that the story that you tell in your documentation report actually matches what's happening and matches all the other documents that might be requested by a tax authority if that taxpayer comes under audit. Of these, the first one, the financial statements, that's pretty obvious. At the TP Mines conference that was in Miami a couple weeks ago, I was there, and during one of the presentations, one of the speakers said that the beginning of any analysis should start with the financial data. And I sat there and in my head, I was thinking, well, I kind of disagree with you. It needs to start with a discussion of the business with the, all of the relevant people that are working there. But then when I looked at my information requests, my number 1 right at the very top of my list was financial data. So maybe I don't disagree so much with that's where you start. But it's, other than requesting these things, determining comparability is about gathering all of the information about the functions, risks, and assets from your client. And it's hard to do because there are a lot. There's a very long list of functions. There's a list, the OECD gives a list, the Brazil Tax Authority gives a list. There's a list of these functions, risks, and assets in almost every set of transfer pricing regulations out there. And they're not always the same, but it's important to cover everything that's relevant, which might not be the same set of functions or risks or assets every time. it might even change for the same customer over time, depending on their business and how it changes. So one of the things that I found that helped me and my team just be organized, also we determined that also it helped us when we had a client under audit, and it's a chart. And I think a lot of practitioners use a similar chart, and that's what we're going to look at. That's what we're going to look at in a minute. But all of the information, so this is just the first part of an information request, but all of the information that we're gathering, it's going to be summarized in this chart. We found that the IRS doesn't particularly like to read a long description, and they like pictures and charts, and that really helped us out under audit. So, we could gather all of the information in this information request, and this was just the very first part of the information request we would send out every year to clients. All of this information can be summarized on the charts that we're going to get to. And, the information request would have, the same general information like you see here for any of our clients, but then it would be tailored after that. It would be a little bit different if the main activity was manufacturing or distribution or some kind of research and development. But this general information we asked every time. And here's the beginning of the chart. So in the chart, there are these columns. The first column, you're going to see the actual function or the activity. And in the next two columns, that's where you list all of the related parties that are involved. And one of the things that I see sometimes in a transfer pricing report is that the description of the functions, risks, and assets, it only covers one entity, but really your function, risk, and asset discussion, it should cover all of the entities that are involved. And it might even be more than two. It could be all of the entities in the group, or it could be the two entities that are interacting, plus maybe the headquarter entity. Maybe they provide some services as well. And usually I'll keep 3 columns here, but it didn't fit very well on the page, so I just have 2 entities listed. And the way it worked for us to break up the functions, because it was easier to think about comparability this way. And it's also how the IRS tends to break up their functions. It's first general management functions, which are these listed here. And I believe you guys have already had a class on functions, risks, and assets, I believe. So we won't go through all of these, but just to show you the groups. The first one is general management. And the next group has to do with manufacturing activities, from the beginning of the activity, which is bringing in raw materials, the research and development, all the way through the completion of the manufacturing and the quality control process. And the third group of functions has to do with marketing, sales, and distribution. And the way we would fill out this chart, and the way I've seen this chart filled out by other teams. So I started my transfer pricing career at EY. I also worked at Grant Thornton and at Mazars, and at all three companies, we used similar charts. And the way we would fill these out, though, was a little bit different. And I've seen lots of different ways. So this is how we would fill it out. So in each of the columns, for, the related party 1 and related party 2, we would determine for each of those functions in the chart that we just saw, we would put these pie shapes, and the the amount that's filled in the pie would be determined by what percentage of that activity was performed by each entity. And even if you're benchmarking a distributor, I would still keep in the section that describes manufacturing activities. And maybe you have, the pie that is not shaded in at all, the one on the bottom that says does not perform. Maybe you have that circle, does not perform for each of those activities, but it's still important to describe the activities, even if they're not being performed. So I wouldn't assume that tax authority would just know that a function's not being performed just because it's not described or discussed. So even if it's not performed, still just make a note, not performed. It's quick and it saves you potential time and questions later on. This is how we did it, but I've also seen some teams put a big X if the entity performed that function by itself, and a small X if the entity was performing that activity along with its related party. I've seen 1 to 3 X's being used. I've seen check marks being used. So I think the way the type of, the pie or the check mark or the X that you use doesn't really matter, as long as you have a good definition for what it means. So for every chart that we filled out, we included it in our documentation report, but we also had a definition of what the pies meant. And that would be the same if we were using X's or check marks. I would still put the definitions just like this. And it's not just for the functions, although that gets most of the airtime when we're talking about comparability, it's the functions. But also we would fill out the chart for risks. So we have this list of risks, and it's, a very similar process. And here are the definitions for the pies related to risk. So it's a similar idea, but just a little bit different. It's because the functions are being performed, but the risk is being assumed or is being borne. So the wording is a little bit different, but it's very similar idea. And the same for assets. And we split the assets up, or I typically see assets being split between intangible and tangible. I still like to split up my intangibles a little bit further between marketing assets and manufacturing assets, although the OECD says that's not how you're supposed to do it. It's easier for me to think about it like that. And before we, is there a question? No, just background noise. Before we would even start a discussion with a client, we would send them this chart. But along with the chart, we would have definitions of all the functions and all the risks, because part of the issue when you're dealing with clients is that the language of transfer pricing, it's a little bit different than your everyday language. So just to make sure everybody was on the same page and that the client, had their head in the right spot, we would send the information request along with this chart before we would have our discussions. We would usually let the clients know, we don't expect you to fill anything out. We don't expect you to write any answers to our questions, but it would just get them thinking about it. And that it helped because it would help them know who we needed to talk to. So we could set up meetings, but there might not be the right people in the meetings to answer these questions, except that we had already sent them this material to the clients so they would know who we needed to talk to, and that was really helpful also. And here's the same definitions for the assets. Very similar idea, just a little bit different wording. And the reason why you're gathering all this information is for I was about to say two things. Really, there's three reasons why you're gathering all this information. One is because you need some content to put in your documentation report. So that's one. But the real reasons are that you're gathering this information to help you determine what the best method for analysis is going to be. And the second reason is that this information is going to help you determine comparability. So when you're reviewing potentially comparable companies, you're looking at all of the facts that you've gathered, and you're helping that inform your decision of, yes, I'm going to keep it in my final set of comparables, or no, I'm going to reject it. So after you gather this information and you have that chart filled out, and you finished describing all the functions, risks, and assets, and how they're split between the related parties, you characterize the two entities. And this isn't done in all of the transfer pricing reports that I've seen, but it's done in a lot. So the end of the functional analysis section, you'll have like a summary where it says, okay, given all the information we've just described, we've determined that entity number one is operating like this type of manufacturer or this type of distributor, and here are the definitions. And I pulled, it's sort of a continuum where, you might have an entity operating at either end of the spectrum, but usually it's somewhere sort of in between. But this, even if this characterization isn't perfect, it's still used a lot of the time. And so this goes from fully fledged manufacturers to contract manufacturers to toll manufacturers. And the fully fledged manufacturers are the ones that perform more functions, more activities. They bear more risk, and they'll own more IP. And it's the opposite at the other end. The toll manufacturers, they perform limited functions, have limited risks, and own limited, if any, IP. And it's these three buckets aren't going to be perfect, but they're something that a tax authority would understand. And it helps take all that information and summarize it. So because I think there were maybe 28 different functions, I don't know, 8 or 10 different risks, 6 or so different types of assets, and that's a lot to keep in your head. So a summary like this is helpful, even if it's not perfect. And these are the characterizations that you typically see for manufacturers. And we have the same for distributors. They didn't all fit on one page though. So we have marketer distributors at one end. Those are the entities performing more functions, taking on more risk, owning more IP. And distributors are in the middle of that. And at the other end, less functions, less risk, less IP ownership will be the commission agents or commissionaires. And at this point, you're ready to pick your best method. Were there any questions?
Margaret, yeah, I think Luis wanna ask some questions.
Yeah.
Thank you, Larissa. Hello, Margaret. Good night. Could you back to the slide which you talk about manufacturing, please?
This one?
Yeah, this one. When I work at BDO Brazil, and we use 4 entity characterization. What do you think about license manufacturing?
Yep, that would be good. I've seen a list, I think, with 5. I just couldn't remember the other 2. So I would use, the more precise you can be, the better. So if you have 4 or 5 different characterizations, I would definitely use those
Well, okay. Thank you.
for sure. I just couldn't, if I would have had more time, I would have gone through all of my old reports to try to find a more complete list, but I can do that after this class too.
Okay. Thank you.
So this class is just about tangible products and the method selection. I pulled this list from the Brazil regs, and these 6 or 5, +1 methods, they're the same methods that you'll see in the OECD guidelines and pretty much in any set of transfer pricing regulations globally. And there's some things to keep in mind. It's about the facts and circumstances that you've just gathered from your client, but it's also about the availability of data. And if you're having to make assumptions because the data is not perfect and you're saying, I know it's not perfect, so I'm assuming this, and we're making these adjustments, you have to think about the reliability of those adjustments, and not just the reliability of the adjustments, but how much do they change your results? So if I'm making an adjustment and it really changes the results, I might think that adjustment, it may or may not be correct. Every time I'm making an adjustment and it changes my interquartile range, or it changes any of the PLIs used by that I'm using, if it changes it very much, I go back and I think, okay, maybe that company wasn't actually comparable to start with. So other than just the facts and circumstances, there are also some, almost administrative kind of things that you need to think about when you're picking your method. And this is the information on the prior slide. There was just a lot of text. So this is just the abbreviated version of the prior slide. You're looking at comparability. So that has to do with, the information that you gathered from your client, but also is their data available? What assumptions did you make? And how are those assumptions or potential issues with the data going to affect your results? And so when I started doing transfer pricing, there was a hierarchy of methods, but in 2010, the OECD decided that it was going to get rid of the hierarchy and go to the best method rule. And even though it did that, there's still a little bit of a hierarchy where some methods are preferred over others, and I don't think that's ever going to change. So if you have, if it's possible to use a cup method, and we'll talk about that in just a second, that's the one that you should use, because that method is the method that will give you results that are most likely to be correct. It's very hard to disagree with the analysis and results that you get from a cup method. And the next level down, if you don't have the data available to use that method, and we'll talk about why in a second, the next methods after that would be the resale price and the cost plus method. And that's because those are considered transactional methods, and those are preferred over the TNMM and the profit split method, because those are more indirect methods. Those are methods that will benchmark a transaction based on the profit earned. And so those, although the 10 mm is the method that is probably used, I don't know, 85% of the time in all of the transfer pricing analyses that I've seen, or that I've talked to other people in the industry about, or that I've talked with tax authorities about, the 10 mm is used in the great majority of those cases. And that's good for us because that's the method that you would pick if you're using the TP Catalyst tool that we're going to talk about in a minute. So first, the cup. I don't know how good these pictures are. If they make sense to me, I don't know if they make sense to anybody else, but the pictures are what helped me kind of wrap my head around what the different methods mean and how they can be applied. So for the cup method, you can either have for the cup method, it's best to use internal comparables. And that means you're looking at a transaction that you have between two related parties and between one of those related parties and an unrelated party. So for a cup, and remember, we're thinking about tangible goods in this class. So for a cup, if you look at the controlled transaction for both of these groups, so it's the one on the top and the one that's the third down, it's the same. But in the first one, you're looking at a manufacturer who sells products to a related and unrelated party. And it's that price that you're going to use, those prices. And in the second group, you have a distributor, and it purchases products from a related manufacturer and an unrelated manufacturer. So it's those prices that you're going to use in your benchmark. And so that's a cup. It's almost always with internal comparables, but you need to look at it from both directions. It can be selling to or buying from. And some people forget that. And here's some of the comparability factors that are important for a cup. For a cup, your product has to be almost exactly the same. And this is the method where contractual terms are very important. So probably the first two bullets here are going to be key. And depending on what type of product, the date and time might also be important. If you have commodity goods that are sold on an exchange, then the time is also going to be a factor in comparability. But really, it's the top two bullets here. The good has to be very much the same quality, the same volume, the same everything. And the contractual terms, how long do you have to pay? Is there a volume discount? Things like that have to be the same, or you have to be able to adjust for those in a reliable way. In the next two methods, the resale price method and the cost plus method, they're like mirror images of each other, but one is to benchmark distributors or distribution activity, and the other one is to benchmark a manufacturer or manufacturing type activities. So the top row shows your controlled transaction, but for both the resale price and cost plus, you can use internal or external comparables. That said, internal comparables are always going to give you a more reliable result. And this way, you're only going to be looking at the distributor. So for the cup analysis, you could look at the related manufacturer or the related distributor. But here, for the resale price method, it's only to benchmark distributors. So we're not we're not going to look at the manufacturer if we're using this method. And it's the opposite for the cost plus method. So for both the resale price and cost plus methods, the similarity of the products, it can be a little bit less. So the comparability requirement is a little bit lower when it comes to the product that's being bought or sold for these two methods than it was for the cut method. But still, it's that comparability requirement is still higher for these two methods than it is for the TNMM that we'll talk about in just a minute. And so the relevant comparability factors for the resale price method and the cost plus method, 3 are the same. The functions, risks, and assets, contractual terms, and exchange rate risks are the same. But because for the resale price method, we're looking at a distributor, then the next two comparability factors are going to be different than they are for the cost plus method. So we're looking at the market level and any other sales or marketing activities. Those are going to be important when you're determining comparability. And this highlights the reason why I think I've only used the resale price method a couple times in, all of these years. And I don't think I've used the cost plus method. I might have used it once, maybe twice. And it's because both of these methods are at a gross margin level. So the PLI for these methods, the numerator is the gross margin. And so if you look at these examples, both example 1 and example 2 here, they have the same total costs. So it's 100 for both example 1 and example 2. The costs are just split differently between COGS and SG&A. And because this is a gross margin analysis, that's going to make a difference. And it's very, very hard. It's to determine if the way your comparable companies have split their costs between COGS and SG&A. It's hard to determine if that split is the same for the comparable company as it is for the tested party. You know almost all there is to know about the tested party because they're your client and you can ask, but you can't ask the comparable companies, hey, this item that normally goes in SG&A, did you put it there or did you put it in the COGS bucket instead? So it's very hard to be sure that you're going to get a reliable analysis at the gross margin, just because you don't know how the costs were treated from an accounting perspective. So, and you can see how the bottom row here, just because some costs were moved from COGS to SG&A, you can see it really made a difference in the PLI. And that could move your tested party in or out of the range. And it's the very same thing for the cost plus method. So here's the cost plus method, very much what we just saw, except the tested party here is going to be the manufacturer. And again, you can use internal or external comparables. I would definitely pick the internal comparable over external. Always going to be more reliable. And the same with the comparability requirements, the comparability of the product, a little bit less or a little bit lower threshold than what you see for a cup analysis. And we see the comparability factors that are the most important for this method. We see the same 3 that we just saw for the resale price method. And in this case, because we're talking about a manufacturer, we see that purchases, activities related to inventory and and testing or quality control are more important. And we have the same issue because the cost plus is also a gross margin analysis. We see the same issue that we just saw with the resale price method. In this case, the PLI is the gross margin divided by total cost, where before it was the gross margin divided by sales. So our numbers are the same, but our PLI, because the calculation is different, the numbers are different, but you still see that the split between COGS and SG&A, how those costs are bucketed, it's going to make a difference. And so that's why these two methods, unless, even though tax authorities, put those close to the top of the hierarchy, I tended to avoid these methods if I could. And that brings us to the TNMM. And after this, we have the profit split, but we'll probably just briefly cover that. So the TNMM, it's used, more often than all of the other methods put together. And that's because it's relatively easy to use. There's data available, data that, the same databases have been used for years and years. Tax authorities are comfortable with this method. Practitioners are comfortable with the method. But the only issue is that this tests the transfer prices in an indirect way, because it's looking at profit and not actual transactional data. And one other argument that I have heard tax authorities bring up is that with the TNMM, you're just testing one side of the transaction, and that can make a difference. You can pick, there are rules for how you pick a tested party. It's supposed to be the least complex of the two entities that are engaged in the transaction. It's supposed to be the one that is taking on less risk. It owns the fewest intangible assets. But sometimes that's hard to say. And sometimes it's about the story that you tell. So there is some arbitrariness when you're picking the tested party. You also pick the tested party based on the data that you have. Even if you know that the least complex entity is, entity number one, you might not be able to pick it because you might not be able to get financial data on that entity. So if you're engaged by a subsidiary of a group, you can get that subsidiary's financial data, but you may not be able to get the financial data of the other related party engaged in that transaction. It's easy if you've been engaged by the headquarter company of a group, you can get all the data for all the group members. But if you've been engaged by a subsidiary of the group, you might not be able to get the financial data from the entity that that's on the other side of the transaction. So that's the other issue with this method. And one of the things with this method, other than picking the tested party, you also have to pick the PLI, or the profit level indicator. And that's the ratio that you're going to use in your analysis. Where for the other methods, you're told what PLI there is. There's no choice because there's just the one. But for the TNMM, there is a choice. The numerator and the ratio is always going to be the same. And it's EBIT. So the numerator is supposed to describe the profits that are earned by the activities related to the covered transaction. So it's not going to include any items like interest expense or interest income. It's also not going to include any taxes that are paid, any income taxes that are paid. The numerator, that's the easy part of the ratio, but it's the denominator that can get you tripped up. And you pick the denominator based on the tested party and its interactions with its related and unrelated parties. So you want to pick the denominator based on either the sales or the cost that the tested party has with the unrelated party. So in the first bullet, it's net revenue. And here, if your tested party is the distributor, you want to pick the piece of its income statement that relates to its activity with the unrelated customer. So because it's a distributor, it's selling to the unrelated customer. So in this case, you're going to have net revenue or sales in the denominator. And it's the mirror of that for a manufacturer. So if your tested party is a manufacturer, it's purchasing goods from an unrelated supplier in this case, and it's selling goods to a related distributor. So you want to pick the piece in this supply chain that is with the unrelated entity. So for a manufacturer, the denominator is going to be costs, because the costs are showing up on its income statement related to the products that it purchases from that supplier. I'm not sure if that makes sense or not, but it's the manager that I worked for when I first started doing transfer pricing at EY. He drew this same picture for me, and then it started making sense after that. There's some other PLIs that you can choose. You can choose one that has operating assets on the bottom. And there's some other PLIs like the Berry ratio, return on capital employed, and even some other ones beyond that. But the two that you see most often are the first one, the operating margin, which is EBIT divided by revenue, and the second one, which is the markup on total cost, which is EBIT divided by cost. And there's a question?
Yes, hello, Margaret, thank you. With regards to the option with the operating assets, I understand that normally you put that also on manufacturers, right? But is there a formal, a direct measure to judge if an entity is capital intensive or not? I mean, how you can define if your tested party uses a lot of capital or not?
Right, and that's just, it's almost like a feeling that you get when you're going through the information gathering and the discussions. And it's a little bit different now since COVID, but before that, every time any of the groups that I worked with, anytime we started a new analysis, we would go and do a site visit. We would go to where the client operated. And if we were looking at their manufacturing activities, we would walk through and we would get to see, just how capital intensive or labor intensive the process was. So some of it is just the feeling that you get. But if you use that because there is a capital intensive process, I would be very sure to describe all the reasons why you think that. And it could be like the value of their equipment versus the number of employees. It could be that it's a norm in the industry that all of the equipment being used is very important or very expensive or hard to find. It could be hard to get. So all of those reasons would need to be documented. It's almost like when you're doing an analysis, every choice you make, you have to be able to defend. And the more clear and detailed your documentation report is, then the less questions you're going to get from a tax authority. So for every decision, like, choice of PLI, I would do my best to describe as fully as possible why I chose that one. And it's not only knowing if an entity is capital intensive or not, that's part of it, but also how are you going to define operating assets? It's really difficult to define operating assets. When I was working on this presentation, I think I found 5 or 6 different formulas or different ways to define operating assets. It could be the return on capital employed. It could be return on assets. It could include current assets. Some formulas did not. Some included intangibles. Some did not. So it's very arbitrary. My personally favorite PLI is the Berry ratio. And that has made every partner, everyone that I've ever had to report to, it's definitely made them cringe that was my favorite PLI, because it is the most, you're setting yourself up for having an argument from the tax authority if you pick that PLI, even if it's correct. Usually when I would decide I wanted to use the Berry ratio, I would also use another PLI just as support or as backup, or like a corroborative method almost. The Berry ratio is very hard to use. A lot of people use it the wrong way, but it's rarely used. And these are some things that can cause your TNMM analysis to go off track. And it's if these things are substantially different from between the tested party and the comparable companies. One of the big, probably the last bullet, is the most important, or the one that I see the most often causing an analysis to go astray. All of those items listed in that last bullet. And the profit split method, which theoretically, as an economist, profit split method is technically going to be the method that is correct the majority of the time, but it's rarely used. I've used it more than I would have used the cost plus or resale price methods, but it's difficult because there are a couple of different ways to approach it, but the profit split method is used when one of the entities contributes IP, or both of the entities could contribute some form of unique intangible asset, or if there's significant risks that are shared. And when I have used or have seen the profit split method being used, it's the 2-step process. So it's the second version of this that I have seen, where all the routine profits that could be benchmarked with the TNMM analysis, all of those profits are carved out. So it's like you take the 2 entities that are involved and you put their income statements together. So basically just add the sales, add the costs, and add the EBIT. And once you do that, you start carving away. So if you have basic manufacturing activity being performed, You can benchmark it with a TNMM analysis, and then you carve that profit out. The same thing if you have basic distribution activity. You carve it out, and then whatever you're left with, you split. And you split that leftover, or that residual profit based on allocation keys. And the allocation keys are completely 100% every time arbitrary. You can say, I picked this allocation key because of these facts and these circumstances, but for every allocation key I can pick, a tax authority can pick a different one. So it's that split of the residual, which is often the majority of the profit. That is going to be where your argument is. So picking the profit split method, your documentation has to be even more detailed than it does for the other methods. But I think you guys are probably going to talk about this more when you talk about intangibles. So we'll just leave that one there. So for a range of results, there's some rules in the Brazilian regs that talk about the range and whether you need to use the interquartile range or you can use the full range. And it just depends on how reliable you think your comparables are. If you think they're very reliable and either you didn't have to make many adjustments or you made adjustments, but you believe that they were supportable adjustments, then this is hard for me to talk about because the US regs say you use the interquartile range all the time for the TNMM analysis, but it's in the Brazilian regs, you don't have to. So if you trust the reliability of your comps, you can use the full range. But if there's any question, you need to use the interquartile range. And we can talk about that in a little bit. And the interquartile range is just the middle 50%. If you rank order all of your PLIs for each comparable company, and you just get rid of the top 25% and get rid of the bottom 25%, and you take that middle 50%, that's your interquartile range. And I think we are at a good stopping place, I think. We can talk about this. I think we're at the adjustments. So this might be a good time for a break and we can just go through adjustments quickly when we come back and then we'll get right into TP Catalyst if that works. Larissa?
Yeah, yes, can we take 15 minutes? So,
Yeah.
okay, so we'll be back 8:30. Okay.
Perfect.
8:30 então, pessoal. Oi, pessoal, vamos voltar. Hi, Margaret. We can continue.
Okay, excellent. So the next topic is comparability adjustments, but I think we can just go through these pretty quickly so that we can get to the TP Catalyst tool. And there's some adjustments that are expected, some adjustments that you see with almost any analysis, and then some are more tailored and only appropriate at some, for some projects, you know, given the facts and circumstances. Working capital adjustments are the adjustments that you see for almost any analysis. And when I say any analysis, I mean a TNMM analysis. If you use a cup method, then the comparability threshold is so high that you are expected to not need to make adjustments. You can, but that makes the results will be more open to question. So for all of these adjustments, I'm specifically thinking about the TNMM method. And the working capital adjustments, they're also called capital intensity adjustments or balance sheet adjustments because the items being adjusted are on the balance sheet initially. So, and it's usually accounts payable, accounts receivable, and inventory, and sometimes PP&E is included. The formulas are gonna, they look crazy, but they're not difficult, and there's a pattern, and they're dependent on the PLI that you choose. And the reason that you make working capital adjustments is because you're trying to account for, here I have the opportunity cost of capital, but you can also think of it as the time value of money. So here are the formulas, and they look crazy, but they're not as bad as they look. So the first set is if you have sales in the denominator of your PLI. So if you're using operating margin as your PLI. And the second group is if you have cost in the denominator of your PLI. So that would be a markup on total cost. And if you look at the formulas, you see the pattern. So if sales is in the denominator, you're going to see sales here and here, and T is for tested party and C is for comparable. And the only other items other than the same line item that's in the denominator of your PLI will be the item that's being adjusted. So here you see sales and accounts receivable. This bit at the end has to do with the interest rate that's applied, and that should be a small I for the PP&E adjustment here. I'm not sure how that got to be a capital, but it's, so if we talk through one of these formulas, you'll see that it's the same pattern for all of them. So it's, if we're looking at the receivables adjustment here at the top, it's the accounts receivable of your tested party divided by the sales of your tested party. And then that product, or whatever you call an item that's arrived at with division, not a product, but whatever the accounts receivable of your tested party divided by sales of your tested party, you multiply that by the sales of your comparable, and then you subtract the receivables of your comparable. And then you multiply it by this formula that accounts for the interest rate. So you're trying to adjust the accounts receivable of the comparable to match the accounts receivable of your tested party, but you're not adjusting it on its own, like the value like you see in the balance sheet. You're adjusting it based on a ratio to sales, because sales is what's in the denominator of your PLI. And the same formula, the same pattern is basically carried across all of these balance sheet items. And the difference with the interest rate at the end has to do with the holding period. So your receivables and payables, you could have different lengths of time for those payment terms. And that's what HC is. That's the holding period. And that's why the end of the formula for receivables and payables looks a little bit different. And you can see the formulas for a markup on total cost PLI, the formulas at the bottom. They're the same pattern as the formulas at the top. They just replace sales with total cost. So if you look at the receivables adjustment, it's the accounts receivable of the tested party divided by the total cost of the tested party multiplied by the total cost of the comparable. And then you take that and you subtract the accounts receivable of the comparable. So it's the same pattern. We're just substituting total cost in where we had sales before. And that's not quite the end. So this just gives you the adjustment amount, but you have to know what to do with it after that. And this is what you do with it after that. You take, you're going to adjust the sales, the COGS, and potentially operating expense amount, depending on which of those balance sheet items you've adjusted. So for the adjusted sales, you take the original sales of the comparable company and add the receivables adjustment. And for COGS, you do something similar. You take the original COGS of the comparable company and you add the payables adjustment, and then you subtract the inventory adjustment. And for operating expenses, you do the same. You take the operating expenses of the comparable company, the original value, and you subtract out the PP&E adjustment. Those formulas look really terrible, but once you see the pattern and think about what you're trying to do, it makes sense and it's not quite so bad. I mean, it still looks ugly in a spreadsheet, but it's not so bad to do. And there are a couple of other adjustments that are also expected. And one of those is the LIFO to FIFO adjustment. And this just accounts for how inventory is tracked, when it's coming in and how it goes out. So when you're selling inventory, do you take your oldest inventory or your newest inventory? And because that can have a difference, it can make a difference to your profitability, because the cost of your inventory can change over time. You can buy the same product today that you bought a year ago or a month ago, and the price could be different, and that's going to affect the profitability. So to make an apples to apples comparison, we change all of the financials to a LIFO method. And the calculations for that are a little bit simpler than they are for capital intensity adjustment. You just add the LIFO reserve to inventory to get your new inventory amount. And to get your COGS amount, you take the original COGS and you subtract out the difference in the change in the LIFO reserve. And all of those items can easily be found in your income statement and balance sheet. And this is coming from someone who did not do well in accounting class. So none of these adjustments are difficult. And this is an adjustment that it's really specific to the LATAM region. And there's even a note about this in the Brazil regs. And these are the formulas taken from those regulations. The formulas are not bad really at all. Probably the most straightforward of the adjustment formulas we've seen yet. But here the trick is coming up with the country risk premium for the country where your tested party is operating and the country where your comparable is operating. There are a lot of different places where you can get that premium, like Moody's. We have a whole list of country risks. I tried to get it, but our economist group told me I would have to pay for it, so I didn't get it. But we're currently trying to add it to our TP Catalyst product. So once you come up with your final set of comparables and you're making adjustments like the working capital adjustments, you'll be able to make this type of adjustment, and all those risk premiums will be included. But the formula is not bad. The trick is just where are you going to find a calculation of the risk premium? And there are companies like Moody's and Fitch and S&P, but there are also places where you probably could get those premiums and not have to pay for them, like the World Bank or the PRS. On those websites, you could probably find risk premium lists for certain countries. I didn't try, but I imagine the World Bank, if any of these entities would have it, it would be the World Bank. And then there's some other adjustments that that I've made, that I've seen made, that are a little bit more, you make these adjustments kind of at your own risk. They can, while theoretically they're probably correct and they can be applied in a reliable way, you're leaving yourself open to dispute with the tax authority for any other adjustments than those adjustments that we just talked about. I've seen some pretty crazy adjustments with regression analysis, and one time where I didn't run into trouble with it, but someone else in the team that I worked with did, with a client that they were helping who was under audit. And it's because the IRS examiner didn't understand a regression analysis. So, you know, you can be technically correct, but if it's too complicated, even if it's correct, it's probably not going to be acceptable. So I would just caution about that. So now we're to the demos. Are there any questions before we go to TP Catalyst? I have two searches that I prepared. One is search for North American distributors. The other is for Latin manufacturers. And just because you guys will get to keep the slides, I put a couple of screenshots in of the search step process in TP Catalyst. So in this, the middle column, or the big column that's on the left, you'll see our first level of search criteria, and then you can click into most of them and they'll either expand, or you'll see the subgroups on the right, like here. I'm looking at ownership and subsidiaries with, and then on the right, you can see the expansion of that search criteria. And we can walk through this in the tool unless there are any questions.
I have one question. I have a doubt when you talked about the regression analysis. I think I did not understand a little bit. I think I know what is a regression analysis, and I did not understand how would you use a regression analysis in a transfer pricing calculation.
Sure.
And maybe we are not talking about the regression, the econometric regression analysis that I'm thinking about.
Yeah,
So
exactly.
can you tell me how did it occur? Because I think I did not understand
Sure.
more or less how you are. So how can you explain a little bit? Because I I think I do not understand how you reach the regression analysis.
Yeah, absolutely. And the IRS agrees with you. They didn't understand it either. So it's in the particular case that I'm thinking of, we used it when there were discounts, like volume discounts applied, but they were different. So there wasn't a strict formula, like, up to this number of products gets this discount. So we looked at all of the discounts based on the number of products and the discount that was applied. And we came up with, we were looking for that coefficient. And then we used that coefficient in the regression analysis. We applied that to our tested party to come up to say, here's the discount that they would have gotten, but they didn't.
So you try to explain the value of the discount based on a calculation, based on a regression analysis, and the regression analysis was a variable of the formula of the regression analysis that you made.
Yep.
Is that all right? Is
Yep.
that correct?
Exactly.
Okay. Now I understood. Completely different from the transfer pricing rules, that the methods.
Yeah, totally different. Totally different.
Okay. Now I understood because I was lost. Okay, thank you.
Yeah, it's for the same reason that you asked your question is the same reason that I probably wouldn't try that again.
Okay.
It was not super difficult to explain, but it took a lot of extra effort where if we would have come up with a different way to adjust for discounts, it probably would have been better. It would have saved us a lot of time.
No, okay, now I understood, but I was scared because I thought, wow, is there something in the legislation that remit us to a regression in through a calculation in a econometric regression? So maybe I didn't read very well. Did I lose?
No, and it's
I was a little bit scared, but okay, I understood. It's
right.
okay. It's
No,
okay.
you're
Thank you.
exactly right. And I even looked for some articles over the weekend for ways that you could make adjustments. And I was thinking, surely I would see some that used a regression analysis, but I didn't see any. So I don't know if maybe it's fallen out of favor where it's just not used anymore. I'm not sure, but technically it's a correct way to make an adjustment, but whether it passes under audit, that's another story.
Okay.
So, yeah.
Thank you.
So, one thing, even though Fede told me not to put it in the slides, I did anyway. Sorry, Fede. Is this, we won't see it now, but we've added an AI enhancement to our TP Catalyst tool where it will look, you put in some information about the tested party, like the activities, products, industry, and the tool will look at the business descriptions, and we have a couple different versions of business descriptions in the tool, and then it will suggest, accept or reject, and then it will tell you why. So that's the end of my slides, and let me open up TP Catalyst. Let me stop sharing and open up TP Catalyst real quick. I think it probably logged me out. It did. So give me just a second. So I don't know how many of you all have used TP Catalyst or our Orbis product before. But even if you haven't, a lot of databases, here we go. really function in a similar way. You're starting with a big group of companies, you're putting in some search criteria or some search steps to try to reduce that number of companies. And then eventually, when you've reduced it as much as you can, you have to manually review the company information to decide on your final set. So let me share my screen again. And let's see. If I can find TP Catalyst again. Let's see. I think it's, here we go. Okay. Can you guys see my screen?
Yes.
Perfect. So this is the landing page of TP Catalyst, but for you guys, when you log in, it will be blank because all of these items here are just searches that I've done and saved in the past. So the way you'll start is if you click this button. So I'll show you how to create an analysis, but then we'll go back into ones that I've already started. So if we create an analysis here, there are a couple of items that you need to put in before you actually start, and that's just telling the tool about your settings. And one of the things that makes our tool a little bit different from some of the other tools that you might use is that we have these current releases right here. And these releases are like a frozen in time snapshot of the data at that particular month for that year. And the reason why we have this is that most transfer pricing regulations say that you need to use contemporaneous comparable company data. So it has to be data that was occurring because of your comparables were operating in whatever capacity at the same point in time as your tested party. So we wouldn't want to use the January 25 release if we're looking at transaction that occurred or was executed during November of 23. And especially because most tax authorities work on a lag. So right now we're in 2025, but I'm not sure about the schedule of other tax authorities, but I know that the IRS is currently auditing companies for the 2023 and some even for the 2022 tax year. So it's important to be able to go back and pick data that was available at a certain time in the past. So we're going to, other than specifically looking backwards for a particular reason, I would always pick the current release. So we'll pick that. And you have the option of putting in tested party data. And the reason why it's beneficial to put in tested party data is that if you do that, then you can tell the tool to make some of those adjustments that we just saw, like the working capital adjustments, the tool will make for you. So you won't have to worry about those ugly formulas that we just looked at. I always pick all companies here. We have this list because I think we have just a handful of customers that have data only for specific regions. But I would always pick all companies. And this is a little bit tricky. The financial year cutoff is where you tell the tool how to match up your fiscal year of your tested party to your fiscal year of your comparable companies. And because you want the most overlap as possible, the way I tell customers to use this and the way I learned to use this is that following the normal timing convention in most regulations where you take the fiscal year end of your tested party and you take any company with a fiscal year end that is 5 months forward of that and 7 months back of that, and you'll include that in that fiscal year for your tested party. So in this case, the closing date, you're telling the tool the last date to be included in a fiscal year. So if my tested party has a year end of December 31, I'm going to tell the tool to make May 31 my closing date, because that's 5 months forward from my tested party's fiscal year end. Does that make sense? Okay. And then we just click start. But here I'm going to click cancel because I've already started 2 analyses. So we'll start, let's start with the distribution one, just because this is a search that that's easy. I've been doing it for years and years. A North American distributor search, it's probably one of the easiest searches that you'll do, partly because I guess I think it's easy because I've done it so many times, but also because our North American data, it's limited. Not that it's limited for us, but it's limited for everybody, because certain countries have filing requirements that require companies to have to make their financial data public, even if they're private. Like in Europe, a lot of private companies are required to make their financials public. So we have a lot of financial data in Europe, but that's not the case in the US. So we have all of the public financial data that's available. It's just the amount that's available is limited. So I'm going to load this analysis. And over here on the left-hand side, that's our navigation pane. And right now we just see the icon, I guess it's companies. I haven't really looked at it before. The icon for our landing page, and this icon, this is the BVD logo. I don't know if you guys are familiar with Bureau van Dijk. It's the company that created TP Catalyst and that created the Orbis database that Moody's bought a few years ago. So because I've loaded my analysis, you see the navigation pane has expanded, and this will always tell you where you are. And I don't know if you guys can see this orange bar right here, but the orange bar will always tell you where you are. So right now we're on the search page, and if you scroll down, we're at add a search step. I could pick load a search or load a set, but because the orange bar is here, I know that I'm at add a search. And within the add a search step, I'm in my favorites in my group of search steps. And these are the favorites that I have starred. But let's go back one step and let's look at the tested party data page. And so if you wanted to add a tested party, I added one that we had in the database because I just didn't want to type in all the financials, but typically you're going to have to create a company right here. And this is because your tested party, it's going to be the smaller of the related parties that are engaged in the transaction. It's going to be the least complex, the one with the least assets. And usually we have, the parent company or the group as a whole. So almost every time you're going to have to create a company, but it's very easy. We even have templates. If if you prefer to, or if you have financial data already, you can just copy and paste into the template and upload that. But if you are going to add if you're going to add your tested party data, the items that have the asterisks are the items that you have to fill in. So you would put in your company name and you would just make up an ID number. I usually put like 123 ABC. And I think you have to put in the country. And after that, you click save and edit financial data. Oh, company. So let's see if we look at, I'm going back to tested parties. So if we look at the one that I've already put in, whenever you see the pencil, that's where you have the ability to edit something. So here we can edit the information for my tested party. So I'm going to show you the financial data. And this is what the page will look like after you enter, whatever information you want. You can enter as much or as little as you prefer. You just have to put in the name, whatever made up ID number you'd like to give the company and the country. But we have all of this because it was already in our database. So let's look at the financial data. And it's a lot, but here again, you don't have to enter all of it. And it's going to look like even more on this page because we have two different formats for financial data. We have a standard format, which we call our global standard format. And we also have a detailed format. And you just have to put the financial data in for one format. And you also don't have to put in financial data for all of these line items. You would just need to put in financial data for your income statement items, which I'll show you in a second, and for the balance sheet items that you would like to adjust. So if we were just thinking about the working capital adjustments, you would put in data for net inventory. And we're always going to use the net version of these line items. So it would be net inventory. It would be net accounts receivable. And it would be net property, plant, and equipment. Those are the assets in our working capital adjustments. And if we look in the liabilities, we would put, and this is a little bit tricky, I'm not sure why we've done it like this, but net accounts payable, it's trade creditors. And so that's the only thing to remember is that trade creditors and accounts payable are the same thing. And if we're looking at the income statement, it's further down at the bottom. In the income statement, you would just need to put in your operating revenue or turnover, your cost of goods sold, and your operating expenses. I'm not sure why we call it other operating expenses because it's the only operating expenses here. So it's those three items and it will calculate EBIT for you. And because when you are using a TNMM method, you typically have a 3-year analysis. You would need to put in financial data for 4 years for a 3-year analysis because when you are calculating your adjustments, you take the mid-year point of each year. So you don't take the ending balance or the beginning balance. You take the midpoint. So you take the ending balance and the beginning balance and you take the average. So you take the sum of those two items and then just divide by 2. So don't let all of these rows dissuade you from putting in tested party data because it's really just the 4 balance sheet items and then the 3 income statement items. So I'm just going to click cancel because we already have the tested party in here. And I'm going to go back to my navigation pane and go to my search page. And I've added some search steps already. And these are the search steps that you'll see used the majority of the time. Occasionally, we'll see a different search step. In Europe, they use some pretty weird search steps. I had a call with a customer a few weeks ago, and they were having a problem with the search, and I was looking at it. They had 17 search steps, and that was a record number. It's 17 search steps is probably unnecessary, but maybe you need more than the 6 that I have here. But I can't imagine having more than 10 or 12. 17 was wild. And the reason that you're putting in these search steps is you're always looking at this total amount right here. And you want this total amount to be a number that's low enough to be manageable for manual review. And so once you get this number down to what you think is a manageable number, you're going to manually review, certain pieces of information for each potentially comparable company. And that takes time. We have some customers that like this, this number that they're going to manually review to be between 200 and 300. That's kind of a lot. When I worked at Grant Thornton, my manager, the person that I worked for, had been at the IRS before that, and she's at Treasury again now. She always wanted me to limit this number of companies to 100 or less. She said it's a waste of time to manually review more than 100 companies. That was just her personal preference. Sometimes I think I could have gotten a better set if I reviewed more than 100, but reviewing 300, 400, 500 companies, it's going to be unreasonable because it will take you too much time. So if you can put in a good set of search steps, even if it takes a little bit more time finding the best search steps, it's going to save you time in the end. So these are the 6 steps, or maybe 5 of these I would see all the time. So I guess one of them doesn't count. So we just start, the first step is just all the companies. So all the companies we have in TP Catalyst, it's 39 million at the moment. So we have a different database that TP Catalyst runs on, and that database is called Orbis. Orbis has, I think, just over 500 million, like billion with a B, companies in it, but we're collecting data for a lot of different reasons. So a lot of those companies don't have financial data. Well, that's kind of the purpose. We're looking for companies with financial data. So we get rid of all of those, and we're starting with 39 million. I've added this first step, or step number 2. I'm looking for active companies, or companies that we don't know if they're active or not. That's pretty basic. I see that in almost every search that I've seen, when I'm looking at documentation reports that I'm reviewing back when I was a practitioner, or even with customers now. The next step, and this is because the next step covers the location. And it's the location where the tested party is operating. You're looking for comparables in that same area. And most transfer pricing regulations stipulate this, that either you're looking for companies that are operating in the same country, or at least the same region as your tested party. So here I'm looking in North America. And step number 4 is the industry classification code. And here I've chosen the US SIC code classification system. We also have the NACE codes and the NAIC codes. So it's whichever classification system you're most comfortable with. that said, even though I'm most comfortable with US SIC codes, they haven't been updated in a very long time. So they don't exactly match the companies that we would see operating currently. So if I'm having a hard time with the US SIC codes, then I'll usually go to the NACE codes. It's NACE Rev 2. And I'll show you all these in the search steps below. And the final two steps are financial data screens. So here, and there are three pieces of information that you put in for a financial data screen. You put in the line item. So here I'm looking for operating revenue. Here I'm looking for operating profit. And you put in what kind of value. So for both of these, I've just put in with a known value. So I'm ensuring that each possibly comparable company is going to have all the financial data that I need. And then you tell it the time, the number of years, and how many of those years you want the requirement to apply to. So I'm telling the tool that I'm looking at years 21, 22, and 23. And I want companies with a known value for the operating revenue line item for at least 2 of those 3 years. And I've done the same for EBIT. And one thing that I would change here, if I would have really been thinking about it, is that in the Brazilian regs, one of the, I think there are probably 3 main differences between those regs and like the OECD guidelines or the US regs. And one is that your comparable companies, when you're using a TNMM analysis, and it's a multi-year analysis like we have here, and it says you can use a 3-year analysis. The regs say that you need to eliminate companies that have more than 1 year of losses. So I'll show you how we can change this. But the way that I've gotten all of these search steps entered is that I've used this list down here. So we were just talking about activities in industry. For me, I always go to the list, but for you guys, it might be easier to type in your search criteria here, and then it will pre-populate all of the possible criteria that match whatever words you're putting in here. So like if you're wanting to know about status, you could type in status here, or active or unknown. You could put active or unknown in here, and the tool will bring that up for you. I have these starred because they're in my favorites list. If we're looking at location, the one that I chose, it's the first one. And the way you put something in your favorites list is you just click on the star. And once it's orange, it'll show up in this first group. So for the location, if you click on the world region, country or region, you can look at either the individual countries, or you can look at 2 different groups. We have geographical regions, but we also have political regions. And if you want to expand any of these groups, you can click on the arrow and it will expand. And for me, I know the countries that are included in North America, but if you didn't, you could click on that arrow also and it will expand and tell you what countries are in that region. And once you've selected, once you've decided on the countries or regions that you want to include, you just click the plus and it shows up on the right, and then you click OK, and that will be added. Because I already have this in our set, I'm just going to click cancel. Yeah. And so that was the world region. If we were looking at the status. Oh, but I think I need to move things along. So I guess because we need to move things along, I would just type in right here any of your search criteria. I am going to show you how to look at the financial criteria step. And it's because there are these three pieces of information to include. One is the variable. So you can either pick from the balance sheet items or the income statement items. And for this step, I picked EBIT. So you just click on it here. But this OK won't turn blue, so you won't be able to select OK until you've made all the choices that you need to for these three pieces of information. So we've selected the variable from the P&L. It's the EBIT value. And under values, I've selected all companies with a known value. But if I would have been thinking, I would have just picked value here and put a minimum of 0. And doing that tells the tool that I want companies that are at least breaking even and not making a loss. But instead I selected all companies with a known value. The third piece of information you have to put in is the time period. You select the years. You can pick between relative and absolute years. I don't think I've ever used the relative choice, so I'll pick the 3 years that you're including in your analysis. So I picked 21, 22, and 23. And if you scroll down, then you get to tell the tool which of those years do you want to be included in this step. So you can pick 1, 2, all, or an average. So I've chosen, I think I chose two of the 3 years. So for 2 of the 3 years, I want the EBIT value to be equal to or greater than 0. Or actually, I think I picked a known value, but if I were doing the search in Brazil, I would have picked the 0 as a minimum to make sure I didn't have any companies with losses in 2 or more years. And yeah, so once you have your search criteria entered, and you do that either by clicking here and then looking at your options here, or you can search for whatever criteria you're looking for. Then you can view results either by clicking here, or you can follow the navigation pane over here. So if we're looking at results, we'll have these 83 companies. And what we just put in were search steps. You also have the option of adding a screening step. And you have the same criteria that you did before, exactly the same. But the difference is that when you use a search step, you're eliminating companies from your final set, or from companies that you'll see that you'll be able to manually review. But for a screener step, you're not eliminating the company if it doesn't pass that step. You're just flagging it. So because I'm looking for distributors, I decided to add a text search. So if any form of the word manufacturer, so I just put in the first piece, MANUF, with an asterisk. That's telling the tool any ending. So any word that starts with MANUF, it's going to include. So anytime this word shows up in the full overview or the trade description, then it's going to get flagged. And you can pick a flag to be one that you're using to include companies in your set, to say, hey, I think this is a good comparable, or to exclude it. And you do that by just clicking these 3 dots, and you can invert. So if it's exclude, then if you click invert, it will change to include. And I usually do the text search in the screening step part of the analysis, because if you're looking for distributors in the business description, it might say, you know, this company is a distributor and it purchases from manufacturers. And because this is just a text search right here, the tool can't make that distinction. It doesn't pick up the context. It will if we were using the AI function, but we're not. So I would save all of my text searches for the screener steps. And once you do that, right here, you have this view down here at the bottom where if you hover over any one of these cells, it will give you the full piece of information included in the cell. And these are all of the companies that we have to manually review. And all of this data, it's data that I've chosen. I've chosen which pieces of data I want to see in the table and what order they're in. And you can do that by clicking here. It's add or remove columns. And basically, all of the pieces of information are the same pieces of information that you can search on. So all of these things here on the left are really the same items that you were able to search on. So if you want to select industry and activities, maybe you want to, like I have the trade description. That's one of the items that I always use. I use two descriptive items. It's the trade description and the full overview. So if I didn't have that already selected, I could just click on the plus and it will be added. It will be added to this list on the right. So these are all the items that I'm going to see in that table. And you can use this button to move the items so that they're in the order that works for you. And after you add all of the pieces of information and they're in the right order that you would like, you just hit apply. And for me, I would suggest picking the, at least to start, I would pick the same pieces of information that I have down here. So especially if you're doing a regional search, I would add the country. And when I'm trying to determine comparability, I'm going to use the full overview and the trade description. Sometimes I'll also use products and services and the history description, but really the full overview and trade description are going to give you the majority of the information that you need. I also cheat a little bit by, I'll add the EBIT margin, and that will let me make quick eliminations, because if the EBIT margin is something crazy, let's see if I can find a crazy one, like this one. So I know that negative 53%, negative 80%, negative 30% margin, it's not a company that I would include. I'll have to figure out why, but I'll know that that will be rejected. So that's why I keep the margins in. And then I'll add some other financial data. I think this is just, I add the operating revenue and I add the EBIT numbers because I think historically I've always done that where it's not necessary. But I used to do the calculations in Excel before the tool is this version of the tool. So these are probably unnecessary unless you're just going to export the results. And the final columns will be important. So they include review and reason, and if I've checked the website, and these are the columns that you would use to make up your elimination matrix that will go in your documentation report. And here in the review column, it tells me what's happened with my screener step. So this first company, it didn't pass the screener step. But this company number 5, it did pass the screener step. So if I'm creating my elimination matrix in the tool, I would go in and click the pencil. And when you do that, it gives you this pop-up box. So even with the screener step, the tool's not making the final determination of accept or reject. The user still needs to go in and make the final determination. So you can pick, once you click on the pencil, you get the pop-up box. You can click accept or reject, or even decide later. And you add your reason. You can either add a new reason, and then you have the option to save it, or you can pick from any of the other reasons, that you might have saved, like this list. And it makes the rejection process really quick, really easy. After you do that, you can go to the benchmarking page. So this is after you've decided, these are all the companies I'm going to reject. Here's my final set of companies after my manual review that I'm happy with. You go to the benchmark page. And when you do that, it will give you a couple of tables. The first table includes the summary statistics. So it'll give you the range, the interquartile range, the median, and it'll give you that for each of the 3 years plus the weighted average. And you have some items here that you can adjust. You can adjust the number of years. You can adjust the companies. So if you're doing a sensitivity analysis, you could click this and decide, okay, I'm going to remove company number 1. And you can see what that does to the range. And then you can just go back in and click next to that company and add it back. So you can add and remove companies from this set really quickly just to see what it does to the results. It won't actually take them out of the set completely. It just takes them out of the calculation. So that's with this pencil right here. You can change the PLI by clicking this pencil. If you do that and you go into the major PLI list, this will have all the PLIs probably that you would ever need. So after you select whichever PLI you're going to use, you just hit OK and it will be applied. The biggest thing to note, or the biggest option that you have on the benchmark page, will be the edit adjustments option. And this is going to be important for a couple reasons. So this statistical adjustments, it's not really a statistical adjustment, it's just the choice of formula used for the interquartile range. So in Brazil, I would pick the average method. The IRS calculates the interquartile range a little bit differently. So if it were a US report, I would pick the IRS method. And this is where you can make your working capital adjustments. I've picked just 2. So you have the option of all 4. You have accounts payable and receivable. You also have property, plant, and equipment. And thought inventory was on here. Maybe it's not in this version. So you have those, oh, it's up at the top. Here it is. So here's the 4th one. So you click on whichever balance sheet item you'd like to make the adjustment for. And then depending on the region or location of your tested party, you pick the appropriate interest rate. And then you click OK. And that's basically it. You have your final set of results here. You'll have the statistical summary with your range at the top. And you'll also have a table with all of the PLIs, or all of the ratios for each company for each year. And the first 2 tables are original data with no adjustments. And the bottom two tables that say after adjustments, those will include those two working capital adjustments that we just selected. And I think that's it. I could talk about TP Catalyst all night, but I'm sure you guys would probably not prefer that. So I think we have half a minute for questions. But I'm also available if you guys are working through the tool and have questions tomorrow or, you know, the next day or the next day. You know, please reach out and I'm happy to jump on a call and walk through, you know, any analysis that you'd like to. Yeah, question?
Thank you for your class, Margaret. And in Brazil, we have the mandatory independence filter. Could you show us how you set it, please?
How you
The
set,
independence. We need to take A plus on the
yeah,
search.
absolutely. So in the search, it's going to be a little bit different. In the OECD guidelines, that threshold is 25%, where I think in Brazil, if you
12.
you need to start with the 20%, and then if you have 4 comparables or less at that point, then you can move to 25%. So here I would pick, if we're following Brazil regulations, I would pick ownership here. And then I'm looking for, so your tested party is usually going to be a subsidiary, and we're looking for the level of ownership that the parent company has or any other group member. So I would pick subsidiaries with, and it's subsidiaries with shareholders by profile. And here I would pick percentage, and you can pick a minimum or a maximum. So if the maximum were 20, that's how I would enter it, and then just click OK. So it's ownership, and then subsidiaries by profile, and then shareholders and percentage.
No, I understand. When I work, we just go to BVD independence indicator and take A plus. What's the difference?
Yeah, so for the BVD independence indicators, that threshold is 25% ownership instead of 20. So the A plus, and I guess A minus, that's 25%. And then the B group, that's that's having a shareholder with ownership between 25 and 50%.
Oh, thank you.
Mm-hmm. Any other questions? This is one of those things that when you see somebody else doing it, it seems very straightforward and you think no problem. But then once you start working through an analysis yourself, there are lots of questions. So please don't hesitate to reach out. I'd be happy to answer any questions. Yep, one more.
Yeah, Margaret, this is a more conceptual question, but here on the Brazilian legislation, they have a requirement when you calculate transfer pricing adjustments. Basically, they say the obvious, okay, if you are inside the interquartile range, okay, you do not need a TP adjustment. But if you do need to make a TP adjustment, you need to calculate by the median of the interquartile range.
Yeah.
I don't know. On my view, this seems a little bit hard on the taxpayer, you know, because I would hear your opinion and your experience. Is this the same approach on the US tax authorities and other jurisdictions? They require you to go for the median when you need a transfer pricing adjustment?
Yeah, it is. It's exactly the same with the IRS. And I completely agree with you. It's harsh because But I think it's meant as an encouragement to do the analysis, to have documentation and to think about it before you file your tax return to ensure that you're within that range. Because the difference between, you know, the upper quartile or the lower quartile and the median, it can be millions and millions of dollars. So I think it's one more way the tax authorities encourage you to do the analysis beforehand. It's almost like a penalty.
Yeah, but in Brazil, they even require that when you calculate what we call the compensatory adjustment. If you calculate the ones during the year, as the true ups or etc., in principle, at least on the way I read the norms, perhaps I'm wrong, but the way I interpret the norms, always when you calculate the TP adjustment, you should be going to the average,
Right.
the
And
median,
right,
I mean.
I think I did read that too. And I think you would do that hoping that you had made enough adjustments in the beginning of the year so that at the end of the year, you wouldn't have to make adjustments and it would even itself out. So if you make adjustments to the median, like after the first quarter or after the second quarter, you're hoping that once you get to the fourth quarter or the end of the year, that you've made enough adjustments that you're within the range. So you won't have to make one there. So you're still following the rules. You're just making your adjustments early so that, you know, in the remainder of the year, the results will even out. So you can end up anywhere within the range.
Understood. Thank you very much.
Okay, I think that's it. Thank you, Margaret. It was really good.
Oh, great. And I'll share the spreadsheet that has like the table of functions, risks, and assets, because in the second tab, it has all the definitions. And that's what we would send to our clients, just so you guys can see it. It's hard to see in the slides, but the slides, I think, will be shared with everybody too.
Perfect. Thank you all.
Thank
Have a
you
good
all.
night.
Thank you.
Thank you, Margaret.
Thanks.
Bye-bye.
Thank you, Margaret. Bye-bye.
Thank you. Bye bye.
Thank you. Bye-bye.
Okay.